Good morning, good afternoon, good evening, YouTube. Welcome back to the channel. In this video, we are going to revisit the TSP. And what do we want to look at? Well, we want to look at the Lifecycle Funds because there are a couple of people that I know. They are enrolled in the Lifecycle Funds through the TSP. And one, they are unaware how they were enrolled, which I'm not sure we'll be able to answer that in this video. Number two, they are unaware how the Lifecycle Funds work. Or maybe they have a general idea, but nothing specific. Or, well, another thing is they really don't understand why you want to either be in the Lifecycle Funds or be in some of the other funds. And so we are going to look at that and see if we can shed some light on the subject. So I'm at the TSP website. And again, I'm going to try to maximize the screen as much as I can for those of you that are viewing on a mobile device. And let's go straight to it. Lifecycle Funds. Here we go. And look at there. They have a nice little video we can watch. Let's check it out.
Your TSP investment options, the Lifecycle Funds. The TSP has a selection of individual and lifecycle funds that let you diversify your retirement savings. You can choose to invest your TSP dollars in everything from short-term U.S. Treasury securities to index funds comprised of domestic and international stocks. In this video, we'll talk about the professionally designed lifecycle funds, also known as the L funds. If you don't have the time, experience, or interest to manage your TSP retirement savings, consider one of the L funds. Each L fund features a combination of the 5 individual funds, G, F, C, S, and I, that is appropriate for your time horizon or the future date at which you plan to start withdrawing the money in your TSP account. Here's how it works. The L funds assume that the farther you are away from needing your money, the more you are able to tolerate risk. Therefore, they give you the opportunity to enjoy the potentially higher returns associated with investing in the stock markets. But the funds continually adjust, so as the time nears for you to withdraw your money, it is more conservatively invested. That way, you're not exposing your entire savings to unexpected market changes right when you need the income. As with all investments, there are risks. The L funds carry the same risks that are associated with all of the underlying individual TSP funds. Watch our other fund videos for more information. To find out which L fund might be right for you, or to learn more about the other TSP funds, watch our entire series of fund videos, or visit tsp.gov to review our fund information sheets.
Okay, so that's a quick little video on the L funds, and they kind of explained how the L funds work. And we kind of said that before in the other video, so let's look at them more in detail. And here in these tabs, we have the different L funds that are available. The first one is L income. And if you look at this, it will tell you exactly what the objective is, who should invest. This is for participants who are currently withdrawing their TSP accounts in monthly payments or who plan to begin withdrawing before 2021. And the goal or the objective is to achieve a low level of growth with a high emphasis on preservation of assets. So that means it's already being distributed to you and you don't want to lose anything. You don't want to lose the value of the account that's already there. So as you can see it by this little pie chart, it shows you that the majority of this is in the G fund, which of course you won't lose anything that's in the G fund. And over time, as you can see this little, it shows you over time. It said something about the quarter I read earlier. Okay, yeah, it will adjust quarterly until July 2028. So each quarter it changes and changes. So, but you can see that the majority of the funds are allocated. The majority of the assets are allocated in the G fund. And then you can look at the annual returns here. It's a chart there, but over here it shows you exactly what it was. And 1 year, that would be last year as of December 9th, 2019. So all of 2019, it made 7%. Okay. Which, is something, but it did not perform as well as, if you remember, my performance of my portfolio was around 29%. So, but the goal of this fund is to keep the income that you already have. So let's look at the 20. So if you remember, these numbers represent, 20, 30, 40, 50 represents, like I said in the video, the time horizon. How much time out do you have before it's time for you to make a withdrawal on these funds? And so for this one, the 20, which is the smallest number, it says for participants who will withdraw their money beginning 2020 through 2024. So that's from now and 4 years from now. If you're going to be, withdrawing in that time frame. And the objective is to achieve a moderate level of growth with a moderate emphasis on preservation of assets. So again, this one, if you look at the wheel, it started out as pretty much the G fund and the C fund were evenly distributed. And you can see it over here is 27% and 34% in the C. But over time, and this is from 2005. So if you had money in this account since 2005, this is how it changed over the years. More and more of it has gone to the G fund and less to these other funds, especially the C fund. And if you remember the last video, the C fund, the green one, is the fund that tracks the S&P 500. And the S fund, this blue one, is the one that tracks the Dow Jones. And in the Dow Jones, it's more volatile. So that would explain the Dow Jones is more volatile. So therefore, the S fund is more volatile. So that would explain why, because this fund wants to achieve moderate level of growth and moderate preservation of assets, which is why this light blue S fund portion is very small and gets smaller and smaller over time. Okay, so the S fund is more volatile, the C fund less volatile, but still gives you a nice chance at a nice gain. So let's look at the returns on this one. So this one's better than the L income fund, but still last year it made only 9%. I say only, but compared to the other individual funds, it made only 9%. And since its inception, only 5%, which is barely above inflation. Let's look at the L50. Let's say you have a long time horizon. Well, we'll just look at them all. So we'll just look at them all. So if you are going to retire between 2025 and 2034, this is the recommended fund for you, the 2030. And as you may expect, the allocation here, this one is more evenly spread between everything except for the F fund. This one has more emphasis on the C, which is good. And so if you look, it also moves to the G, but way later in the years is when it really takes over and starts putting a lot more towards the G. Probably, let's see, it starts 2005. We're talking 15 years in the future. It starts moving to the G. So this is where the allocation is now. So where are we at? 2020, January 2020, February 2020, actually, but it's every quarter. So let's just say April 2020. So this is what the allocation is now. But this allocation picture, this pie chart, represents what it is now if you started back in 2005. If you start today, the allocation is going to look like this now. And as it moves through the years, so what it said through 2034, as it moves through the years, when it hits 2034, it's going to be like this for you because you started like this. This pie chart represents when it was in, when the fund was in the inception of the fund, July 2005. So let's look at the returns. Much better returns last year. Overall better, but only 6% since the inception. So if you think about that, compared to, say, the 2020 or the L income, over time, since they all were the inception of all of them, they were still hovering around 4, 5, 6%. So, it's barely above inflation, and it's not a lot of growth there. So you got to think about that. And the 40, you have a more longer horizon, 2035 through 2044. And you can see it's the same thing. The further out you have, the more you're going to have in these others, and the less you're going to have in the orange. And as you move to the end, when it's time to withdraw, they're all going to look like this. The orange G fund is going to be the majority. So let's look at these returns. Much better returns. Last year, 20%, it's real good. A 3-year return of 10% is excellent. 5-year return, 9-year return. But over time, because those assets will move more to the safe, low-risk funds, you lose all that gain that you had in the beginning of the years. That's kind of a downside I see with going with the L fund, that movement into the low risk stuff. So, but if you made enough money in the beginning to where you're comfortable with the gains that you do have, and you don't want to risk losing them, I can see how it will be beneficial to have something like this. Now, the overall question you have to ask yourself is: do you want to be hands-on with your decisions about where you put your money in your funds, or do you want to just kind of put it on self-drive, autopilot, and let the fund do what it does, and it's going to take care of everything to ensure that you don't lose a lot of money when a downturn happens and you're close to your retirement when it's time to withdraw. So that's the only question. Me, I'm more hands-on, and I don't mind the risk because I feel like I can overcome it through other means. So, but you may not be in that situation, and especially if you're closer to retirement, then you want to make sure you preserve whatever gains that you are able to have. So, and the 50 is going to be just pretty much the same thing as the 40, but even that one, once it reaches the end, even that one is majority in the G fund. Let's look at the returns there. 23%, excellent. 11% over 3 years, excellent. 8% over 5 years, really good. 9% since 2011. Now this one was, the inception date of this was 2011 instead of 2005, and it's actually done good. But keep in mind, this is 2011 and it's 2020 now, so this is 9 years. Over the time frame when it's time to retire and it starts moving more towards the G fund, right? It starts moving towards the G, then this number, this 9%, is going to go down. In the 5 year, it's going to go down, right? So keep that in mind. Me, I would prefer to allocate my own funds and take the chance on making a big gain. So I hope that answered a lot of questions about the life cycle funds. And if you have any questions, please leave a comment down below. Please like, share, and subscribe. I need to build my subscribers up. So you have to share the videos with others so they can subscribe, and we'll put out some more videos, and we'll go through all that the TSP has offers. We can talk about IRAs. We can talk about 401ks. We can, whatever information I don't have, I will look up and I'll put it on video and we'll learn together. So please make sure you hit that post notification, that little bell over there to the right of your screen, and that will ensure that you get notified when a new video is posted. And it may be something that interests you tremendously. Could be some information that you need, some information that you've been wanting to know, and hopefully you'll be able to get that from my videos. So thanks again, and we'll see you on the next one, guys. Thanks.